What an absolutely crazy week it has been in the world of finance. Thank you for tuning in, and I will try to explain in the easiest way what has been going on. Stick around at the end of my video for that, but first let's talk about investing and what you can invest in. First of all, why should you invest? Well, the answer to that is inflation. Basically, more money gets added to the money system each year to encourage you to spend your money rather than save, because if you just keep your money in your savings, then you'll end up losing buying power. For example, if something costs $10 this year, next year it might cost $10.50. So it would be silly for you to save that $10 and not actually earn anything on it, because you won't be able to buy as much next year as you can this year. Each year, inflation goes up 2 to 3%, so that pay raise you get at the end of every year, which is about 3%, actually doesn't mean that you can buy more next year. However, the cost of living index shows us that in most countries, goods and services, as well as the cost of rent, goes up way more than 3% each year, sometimes as much as 8 to 10%. Which is why you sometimes get that feeling at the grocery store like you spend $100 and you don't really have anything in your bags. So the secret truth about inflation is that it actually is beneficial for the 1% and not so beneficial for the 99%. The reason is because with inflation, the things that go up the most are assets like stocks and properties. And if you think about who has the most assets, it's the wealthiest people on earth. Most people actually don't have a lot of stocks. So when the prices go up, it's the richest people that benefit, which is why you've seen a lot of headlines lately like the richest people on earth have made hundreds of billions of dollars in the last year when the rest of the people are having trouble just paying their rent. So in short, that is why you should invest, because if your money is just sitting in savings, you're actually losing buying power when the stocks are going up and the properties are going up and the cost of everything is going up and your money is just staying the same, especially right now when savings rates are around 0.2%. So while your money is earning 0.2% in your savings account, everything else is going up about 3% each year, except this year it's expected to go up 8 to 10% because of all the money printing governments and treasuries have done to combat the problems with that disease thing that we're not actually supposed to say on YouTube because then we get flagged. So I'm glad I just caught myself. Yes, that's right. YouTube has an algorithm that filters out certain words like that, which is why I can't say it. And it also means that that algorithm rewards people for having views and likes and comments. So please help me out and give me a like and share it with your friends. Okay, so why doesn't everyone invest then? Well, that's because it's very intimidating to most people. And why is that? Because they don't actually teach us anything about that in school. And that is the whole reason why I made this channel.
I think you've hit on a huge issue in America today. There's 100 million people that have nothing set aside for retirement. They have no investment account. That is a failure of financial literacy that started as far back as the 70s. We never taught kids in high school. We teach them reading, math, geography, sex education, nothing about investing, nothing about debt, nothing about credit cards. Huge mistake.
I've created a free outlet for all of you to get some intellectual weapons in the war waged against us by the 1%. Okay, now I'm going to talk about the different types of investments that you can buy, and I'm going to leave my opinions out of it because I may be an advisor now that I have that fancy certification, but I'm not your advisor, so unless you're my client, you should speak to your own financial advisor and get the advice that you seek. And remember that TFSAs and RRSPs aren't actually investments themselves, but they are a place that you can keep your investments in to help with tax benefits. If you want to learn more on how to best utilize your TFSA and RRSP, check out my 2 previous videos where I explain both of them in depth. Okay, first on the list that we're going to talk about is stocks, also often called equities, also called securities, and also called shares. And they just use all those other names to try to confuse you and make you feel stupid. Stocks are definitely the most well-known type of investment, and that seems to be the thing that everybody talks about around the water cooler at work. When you buy a stock, you're actually buying a very tiny piece of ownership in that company that the stock represents. Now, most of the time you can't actually buy a fraction of a stock, so if the stock price is $800, then the minimum investment is of course $800. If you want to invest less than $800 in that company, you're going to need to buy an ETF or a mutual fund which holds that company within their fund, but we'll get more into that later. And that's why companies will do things like a stock split. If you don't know what that is, it's basically an $800 stock that they split in half to make it a $400 stock, but now you have two of them, so your value is still $800. But if anyone else wants to buy a stock and only has $400, they couldn't buy it at $800, now they can buy one stock at $400. Many of the biggest companies around the world are publicly traded on the stock market, like Microsoft, Apple, McDonald's, Walmart, and one you may have recently heard of called GameStop. And if you want to hear more about that, make sure you stick around for the end of the video because I've had about 50 people ask me this week what is going on with GameStop. So stick around and I'll try to explain it in the easiest way possible. So the way a company goes from being private to publicly owned and traded on the stock market is by having an initial public offering or an IPO. And if you don't know what that is, I'm going to explain it in a future video because I've had a couple people ask about that already. So, really quick, when you buy a stock, you're hoping that the price of that stock will go up and you can sell it to someone else for more money down the line. The risk, of course, is that nobody else wants to buy that stock and the price goes down, therefore you will have lost some money. Now, technically, the stock is tied with that company. For example, McDonald's stocks are tied to the company McDonald's. But that doesn't always mean that just because McDonald's does well, the stock price will go up. I have seen some companies do very well and the stock price goes down for some reason, and I've also seen some companies do poorly and the stock price seems to go up. And there are different classes of stocks like preferred shares, but I'm not going to get into that right now because that would take an entire video on its own. So if you do want to hear about that, leave a question down in the comments and I will try to answer that in the future. Next up is bonds, which you're basically lending to a government or a corporation or a treasury. And that's why they're called government bonds or municipal bonds, and treasury bonds and corporate bonds. The bond is basically a certificate that says that that particular entity owes you some money. And when the bond matures or ends, which is always a predetermined time, then you will get your initial investment back or your initial loan and some profit in the form of interest from that entity. The rate of return for bonds is typically lower than the rate of return for stocks, but that also comes with a significantly lower risk because when you're investing in a government or a big corporation or the treasury, which is the lowest risk you can get, there's not much chance that they're going to default on that loan. Next up is mutual funds, and if you've ever walked into a bank, you've likely heard of mutual funds. A mutual fund is basically a big pool of investors' money that is spread out and invested broadly over a number of companies. Mutual funds can be actively managed or passive, and if it is actively managed, it basically means that there's a manager who's literally buying and selling bonds and stocks within the funds to try to beat the overall market. Now, the manager can either invest in a whole bunch of stocks, which is usually riskier than other types of funds, or they can invest in a little bit of stocks and a whole bunch of bonds and guaranteed investment certificates, which carries a lot less risk. So you as an investor can choose if you want to invest in a more risky fund or a less risky fund. Usually, investments with a higher risk come with a higher potential return. But everybody has different risk tolerances, especially through different stages in their lives. It's important to remember that mutual funds have a higher fee than most other investments because, of course, you need to pay that manager to manage those funds. Another type of fund is the exchange-traded fund, also called the ETF. Now, an ETF is very similar to a mutual fund because they hold a broad amount of stocks as well as bonds and certificates, but there usually isn't an active manager buying and selling, so what you see is what you get. If there is a mutual fund that you like, you can often find an ETF that has pretty much the exact same stocks inside it, but it's not actively managed, so it comes with a little bit more risk and a lot less fees. Next up, we're going to talk about GICs and CDs, which are guaranteed investment certificates and certificates of deposits. This is an extremely low risk investment because you basically give a bank an amount of money in a predetermined locked up period, and the bank agrees to pay you an interest amount predetermined until that money is unlocked and returned to you. Usually, the longer you agree to have your money locked up with them, they will offer a higher rate of return. The only little risk to that is that, let's say you agree to lock up your money for 10 years, and right now the interest rate they're going to offer you is 1%. Well, if in 3 years interest rates go up quite a bit and you could be making 5% on that money, you may not technically be losing money, but you have lost out on potential gains. Now, you have to make sure you're not going to need this money until they're unlocked, because there are huge penalties for withdrawing a GIC while it is still locked. The next class of investments is options and derivatives, and this is what you're going to be hearing about at the end of this video when I talk about GameStop. This is by far the most complicated way of investing, and you basically buy and sell the options to buy and sell stocks at a future date. That's why you've probably heard them called futures, and you may have heard the terms call and put and long and short, but this is a highly advanced form of investing, so for this video I'm not going to get into it because it would take a lot longer than 10 minutes to explain it. During my master's degree, I learned about options for months, and I still don't even feel confident that I know everything about it. So that brings us to annuities. You can purchase annuities, and they don't offer a lot of growth, but they do offer steady payments throughout your retirement. Nothing really exciting about annuities. You basically purchase a contract from an insurance company, and then you get periodic payments from them. So let's get to this new asset class called cryptocurrency. I'm sure by now most of you have heard of Bitcoin and maybe even Ethereum, but there are hundreds and thousands of different types of cryptocurrencies that you can buy on many different types of popular exchanges. By now, I'm sure most of you have heard of Bitcoin and maybe even Ethereum or Litecoin, but there are thousands of different cryptocurrencies that you can buy on many different popular exchanges. This is a very volatile market, and prices go way up and way down in a very short period of time, so I don't recommend investing in it unless you are willing to take on that risk. But like I said before, usually with higher risk, you can get higher returns, which is why you hear people talking about how they became a Bitcoin millionaire. And nowadays you can spend your cryptocurrency at many different merchants like Starbucks or the Lamborghini dealership. Now, the last type of investment we're going to talk about is commodities. Now, commodities are physical products that you can buy and sell. You've probably heard of physical gold and silver, which are the most common types of commodities, but you can also buy things like wheat, corn, oil, and pork bellies. Commodities usually come with a great deal of risk because they can be highly affected by a change in political views or even things like a change in weather. Okay, now that you've learned about the different types of things you can invest in, let's get to the most talked about thing this week, GameStop's stock. It was actually amazing how many people were asking me this week to try to explain to them what the heck is going on with GameStop stock, and the more terrifying thing was how many people asked me how they can buy GameStop stock. I'm going to start this out by reading a tweet from Elon Musk. He says, "You can't sell horses you don't own. You can't sell cars you don't own. You can sell stocks you don't own? This is BS. Shorting is a scam only legal for vestigial reasons." So the reason Elon said that is because he had a little run-in with some hedge funds last year shorting his company Tesla. That made Elon a little bit unhappy, but since he has such a great sense of humor, he made a joke out of it by making some little red short shorts and selling them online. There is a famous analogy to explain what a short is using snakes, monkeys, and bananas, and you can look that up if you don't understand the analogy I'm going to use, but I think this explains it a little bit easier. In Vancouver, it hardly ever snows too badly. But a few years ago, there was a bad winter with like 3 weeks of straight snow, and snowblowers were sold out of every store in the area. Normally, a snowblower sells for around $200 in the store, but people were selling theirs online for $500. My friend Mike, he knew a guy that was spending his winter down in Florida, but had a snowblower sitting in his garage that nobody was using. Mike asked his friend, "Can I borrow that snowblower?" His friend said yes. Mike thought that snowblowers were so overvalued right now, so he sold that snowblower online for $500, thinking, in just a few weeks, I'll be able to buy one in stores for only $200, and I can pay my friend back the snowblower that I borrowed. In this case, it worked out well for Mike, and all the snow was melted in just a couple weeks, and the stores were all back in stock with snowblowers, so he bought one for $200, gave it to his friend, and kept the $300 difference. So that's basically what a short is. When you think something is way overvalued, you can borrow it, sell it, and then buy it later when it's cheaper to pay back the one you borrowed. But it doesn't always work that way, because sometimes you borrow something and sell it, and then the price keeps going up and you have to pay more for that item just to pay the person back. Now, what happened with GameStop is that all these financial institutions and hedge funds thought that the price of the stock was going to keep going down. Of course, they thought that because nobody really shops in GameStop anymore, because they order everything online or just download it and don't actually have a disc. So they all thought it was a sure thing, and they could bet huge amounts that the stock was going to go down. Well, some very smart person and somebody good at analyzing stock options saw this and decided to post about it on a thread on a site called Reddit, and that thread was called Wall Street Bets, which had millions of people in it who all decided to follow this guy's lead. He explained that if we all buy the stock together, we can make the price go up, and those institutions will have to buy it back from us at a higher price because they already owe that stock. And he was right. The stock price did start to go up, and some of the people that owed the stock decided, even though I'm going to lose money, I'm going to buy the stock now and pay it back, because I don't want to see the stock keep going up and I'm going to have to buy it at a way higher price to pay back the stocks that I owe. Of course, some of the people that owed stocks thought that this price might go up, but it'll come back down and I'll still be able to pay a lower price for the stocks that I owe. The thing about options is that they have an expiry date, so there is a set date that you have to pay back the stocks that you borrow. That date is publicly known when the options expire. So this guy knew that all they needed to do was keep the price high until that date, and when the options expired, all of those big hedge funds would have to buy so many of their stocks at a higher price to pay back the stocks they already owed. They would all make a bunch of money, and the hedge funds would all lose a bunch of money. Well, because the stock price kept going up so fast, it ended up getting a whole bunch of attention by the media. And what happens is that people start to panic and they think, oh man, I better buy this stock before it keeps going. So like I said, they start buying the stock and take a little loss just to make sure that they pay back the stocks that they owe. So when they start buying the stock, it of course forces the price up higher and creates what is called a snowball effect. They buy the stocks at a price higher than they actually sold them for, which drives the price up, and then other people panic, so they start buying the stocks because they owe the stock, and then other people panic because the price keeps going up. The reason this worked so well is because that analyst that started posting about it on Reddit in the first place realized that more stocks were owed than are actually in existence. It was actually around 150% of the stocks in existence were borrowed and owed. How that happens is because so many people thought it was going to go down that they just kept borrowing more stocks and selling and borrowing more and selling and borrowing more, and everyone was doing that up until the point where it was 150%. So this very smart person in the Wall Street Bets Reddit thread decided we can all make a whole bunch of money and make the hedge funds lose a bunch of money. And people like the sound of that because since 2008, when everyone lost money and all the big banks and hedge funds didn't even really get punished, there have been a lot of people looking to stick it to them. And yes, as this got more attention, more and more people jumped on board and then bought the stock, which kept driving the price higher. So to lay it out, the GameStop price actually was $15 per stock. And let's just say that one of these big financial institutions was so sure that the price was going to go down, they borrowed 10 million shares. They could sell those shares for $150 million. Now, let's say they were going to buy back the shares when it hit $10 per share and then pay back the shares, keeping that $50 million difference as a nice profit. The problem is that price of the stock kept going up so fast that some of these big hedge funds thought it was going to come back down and didn't actually take a loss and buy. They kept waiting and it kept going up, and then the price hit $350, which would mean that the person who borrowed 10 million shares would now need to spend $3.5 trillion in order to buy back that amount of shares to pay back the shares that they borrowed. Now, no one actually lost that much money because they did start buying shares before it got that high. But some of these big institutions did lose multiple billions of dollars in this one trade. I'll just read the definition of a short squeeze here because that's what it's called when this happens. So, a short squeeze occurs when a stock price jumps sharply higher, forcing traders who had bet that its price would fall to buy the stock in order to mitigate any further losses. Their scramble to buy only adds to the upward pressure on the stock's price. Now, that's what I was talking about when I was saying the snowball effect. And this is also why I say that options trading is an extremely risky and far advanced form of investing. But hey, you win some and you lose some. And some might say that the hedge funds deserve this, and it was nice to see the little people actually get a win for once. If you made it all the way to this part in the video, then thank you so much for watching, and please make sure to hit that thumbs up down below and subscribe, and also share this video so your friends might be able to learn something as well. And please always stay positive, not just in your minds, but in your bank accounts, because it is a matter of life and debt. See you next time.